Welcome to Acera's pre-retirement seminar. In this seminar, I'm going to tell you all the things you might want to know in the 3 years leading up to retirement, or maybe even in the 3 months leading up to retirement, or the 3 weeks leading up to retirement, because you're going to retire soon. And you may have some questions, like what do I need to know? What do I need to do, if anything? So I'm going to answer those questions for you during the presentation. I really want to help you prepare for your upcoming retirement. So I have organized this pre-retirement seminar into this checklist to kind of break it up and make it easy for you. So we're going to go through the checklist during the whole seminar so I can make sure that we cover all the things you might want to know about your upcoming retirement, including understanding your membership. So we'll talk about a few of the details about your membership and kind of how Acera works. I'll help you estimate your retirement benefit. So we'll talk about the retirement formula, a little bit about service credit. We'll talk about how vacation affects salary. I usually get a lot of questions about that. I'll show you the benefit estimator tool and how that works. And then I will help you verify your retirement eligibility. I'll help you choose your retirement date. I will talk about the process that you're going to go through when you're applying to retire and help you understand that. I'll help you understand the other benefits that Acera offers, including medical, dental, and vision benefits. We'll talk about a few life events and signing up for Acera News. Okay, let's get started. So first off, understanding your membership. Who is Acera? Acera, in one sense, is this acronym, the Alameda County Employees Retirement Association. But it's not just these words, it's made up of a bunch of people. So there's about over 90 of us that work here at Acera, and what we do, our entire job, is to provide retirement, disability, and death benefits to our members. So that's all of you. So you are part of Acera. And you're part of Acera, you're a member of Acera, because of the position that you work in and who you work for. So you work in, or you worked at some point in a full-time position that is retirement eligible. And you work for one of these 6 employers. These are our 6 participating employers in Acera. So because of that position and because of the employer that you work for, that automatically makes you an Acera member. As an Acera member, you pay part of your paycheck into the Acera fund. So every paycheck, you'll see in the deductions column an amount that comes out of your paycheck and goes into the Acera fund. And also, your employer is contributing on your behalf every time you get paid. So we have these 2 sources of money that are flowing into Acera's fund. And what do we do with all that money? Well, we want to maximize that money, so we're going to invest it all over the world. We invest it all over the world, and we earn quite a bit of interest on your contributions and your employer's contributions. And so that interest also is retained in the fund. So these are the 3 sources of income that we have for Acera's fund, the contributions and the investment earnings. And that gives us this big pot of money. So what do we do with that money? Meanwhile, you are working at your job and you're earning service credit toward retirement. So you're paying into the fund, but you're also earning credit toward retirement in a few different categories, which I'll talk about in just a minute. Then, when you go to retire, you are going to collect a monthly allowance, a retirement allowance, every month for the rest of your life, also known as your retirement benefit. So you cannot outlive your retirement allowance. You're going to get it every month for the rest of your life, starting at retirement for the rest of your life. That's really a beautiful thing. Okay. So with those few basics out of the way, let me give you a sense of some milestones that you will see during your membership with Acera. So this is our milestone chart. The first milestone in the the first milestone in the chart is your date of hire. So that is your first day of work. if you started out in your first full-time retirement eligible position, that is the first day that they told you to show up to work, your first day of work. Now, if you didn't start out in your full-time retirement eligible position, this would be your first day in your full-time retirement eligible position. Maybe you started out part-time and then you moved up to full-time, and it would be the first day in that full-time position. Okay, second milestone on the chart is your date of entry into ACERA. This is your first day of ACERA membership, and it is the first day of your second pay period in that full-time retirement eligible position. Okay, then 5 years goes by. Once you have 5 years of full-time service credit with ACERA, or for those of you that have reciprocity, which is when you've linked another retirement system with ACERA, full 5 total years among all the systems linked together. So once you have the 5 years, you're considered vested in the retirement system. And vested just means that you're guaranteed the vested benefits. Vesting just means guaranteed. So you're guaranteed the vested benefits, you're guaranteed the guaranteed benefits, basically. Okay. Next milestone is sometime after you are vested, then you become eligible to retire. And it's based on a combination, usually, of the amount of years of service that you have completed and your age. And there are a few different scenarios, which I'll go into later on in the presentation. I'll talk about those in detail. But when you hit that combination, then you become eligible to retire. After you're eligible to retire, you can start looking at the next milestone, which is your retirement date. That's a date that you are going to choose, and I'm going to help you choose that date later on in the presentation. Okay, so this is your first day of retirement, and you're going to be retired and collecting that monthly lifetime retirement allowance for the rest of your life. And in fact, your death is one of the pension milestones on this chart. Sorry that I had to put it on there, but it is inevitable. So my apologies. But the reason that it's on here is because between this date and this date is when you are collecting your retirement allowance. And then there's an additional milestone after your date of death, which is if you name a beneficiary for a continuance, which is a continuing death benefit that they can get every month for the rest of their life, then that continuance would continue until their death. And we'll go into all that in detail later on. Okay, so that's kind of a high-level overview of the pension milestones. So let's see what's next. Okay, so this is one section of the retirement worksheet that I asked you to download. Now, if you haven't downloaded it yet, let me show you where it's located. So I'm going to do a different share. Here is our website. And let me just pull this over here. So you are going to find these worksheets where you found this seminar. It's under News and Events, Retirement Planning Seminars. Scroll down to the pre-retirement webinar. And here is the worksheet PDF. So this is what the full worksheet looks like. We're going to look at this section, this box right here first. What this worksheet is your takeaway from the seminar. I used to do this seminar without something like this, and I got a lot of comments of people who really appreciated the seminar, but they kept coming back, and so they weren't retaining the information. If you want to, while we go along with the seminar, you can fill in the numbers that you discover for yourself. So this is your retirement situation. And so you can fill in the numbers as we go along, or you can do it after. Okay. So let me go back to the presentation. And we'll just focus on this My Career Timeline box for the moment. So now that we know your ACERA entry date, which is the first day of your second pay period, you can put that in here. But that could have been some years ago. So what I've written up here is it can be approximate dates here. If you only remember that it was like, November of 2004, then you could put that in there. Or if you just remember 2004, you could put that in there. Uh, you can do that way if you want. If you want to get the exact date, you can log into your account on our website and it will tell you your exact ACERA entry date. So you can fill that in now if you like. And also, if you want to, you could, if you happen to know what your retirement date is that you're targeting, you can fill that in right now. You may want to fill it in over here and leave some room because I might tell you something during the seminar that might change your mind on what that date is a little bit, or you can put it in pencil. Okay, let's talk really quickly about vesting. Like I said, vesting means guaranteed. So when you're vested with the 5 years of service credit, you are then guaranteed the guaranteed benefits upon eligibility for them, upon retirement eligibility. And that guarantee is written in the state law. So the state law governs everything that we do at ACERA. And the vested benefits, the guaranteed benefits, are that lifetime retirement allowance, a cost of living adjustment, which is an annual increase to that retirement allowance. And then there's this $1,000 lump sum death benefit that's considered a vested benefit. There are other death benefits that I'll talk about later on that go along with the lifetime monthly retirement allowance. Okay, so now that you know your vested date is 5 years after your ACERA entry date, or if you have reciprocity, 5 years total. So it would be from 5 years once you've reached 5 years total among unlinked systems. You can simply add 5 years if you've only worked at the county or been an ACERA member. You could just simply add 5 years to this date. But the vested date is often not super important. You can just kind of get approximate if you want to. Okay. More pension details. You're in one of these tiers. And so it's important to know which tier you're in because that will help you understand some of the details I'm going to share with you during the presentation, and it will help you understand how your retirement works as you go through the retirement process. It's based on your date of entry into ACERA, so that first day of your second pay period in ACERA. So the way these timelines work is first you find which timeline you're on. Safety members are sheriff's deputies and probation officers and other sworn officers. So if you're a safety member, you know who you are. So you're going to look at this timeline. Everyone who's not a safety member is a general member. So you can look at this timeline. Unless you're a general member for the Housing Authority or the Livermore Area Recreation and Parks District, and then you would look at these, whichever timeline applies to you. Okay, the way these timelines work is if you entered ACERA before July 1st, 1983, and you're a general member, then you're in Tier 1. If you entered ACERA July 1st, 1983, all the way up to December 31st, 2012, so the day before January 1st, 2013, you're in Tier 2. Now, on January 1st, 2013, that's when it changed to Tier 4. So if you entered ACERA on this date or after, then you're in Tier 4. And so that's how all of the timelines work. Now, for safety members, one more thing I want to point out is if you entered ACERA on October 17th, 2010, all the way up to December 31st, 2012, you're either in Tier 2C or Tier 2D. Now, which one you're in depends on the choice you made at the time when you first entered. You had 45 days after you entered your safety membership to make a choice. And if you didn't make the choice, then you were defaulted into the lower tier, which I think is Tier 2C. So that's how that works. And also for safety members, you may have some time in a general membership position because you may have started out as a general member. So when we do your retirement calculation, we'll take that into account. So you'll kind of have a split tier. You'll have some time as a general member and most of your time as a safety member. So now that you know which tier you're in, on your worksheet, you can go ahead and mark which tier you're in so that you can remember it later. And if you're a safety member, you can, and you have some general time and some safety time, you can mark both on the sheet, or you can do a separate worksheet for each part. Okay. Next item on the checklist. Let me help you estimate your retirement benefit. And in estimating your retirement benefit, the first thing that I'm going to do is help you understand how we calculate your retirement benefit. So I'm going to explain how the pension formula works, and then I'll make it easy to understand how we're estimating your pension benefit. When you go to retire, you are going to get in retirement, in your monthly retirement allowance, you're going to get a percentage of your highest salary that you were earning before retirement. You're going to get a percentage of that for each year of service that you worked, each year of service credit that you earned. Okay. So to give you an example of how that works, how we calculate that out in the pension formula that we're going to do for you at the time of retirement, let's say that the percentage of your highest salary that you're going to get for each year of service is 2%. And let's say for this example that you earned 20 years of service. So you worked full-time for 20 years, you earned 20 years of service credit. That means that you are going to get 2% of your highest salary for each one of those 20 years. So if we multiply it out, that means you're going to get 40% of your highest salary in retirement. Now let's say that your salary, your highest salary, just to continue with the example, was $5,000 per month. So that's your average salary, your highest average monthly salary was $5,000 per month. Well, in retirement, that's what you were making while you were working. In retirement, in this example, you're going to get 40% of that amount. That means that you're going to get $2,000 per month. So that becomes your retirement allowance. Okay, so that's just one example. Now, regarding the percentage, the age factor percentage, to dig into that a little bit deeper, it's not going to be, most of the time, it's not going to be exactly 2%. It's going to be based on your age when you retire. So your age at retirement determines the age factor percentage that we're going to use in the formula for you. And here is a sample of the chart that we're going to use. So here are some of the age factor percentages. And the way that you use this chart is you're going to find your tier on here, and you're going to ignore all of the other numbers. So for example, if you're a general member and you're in tier 2, you're just going to look at this column, and you're going to ignore all the other columns. So the way this is going to work is when we go to put a number in the formula for you, we're going to look at your age on your retirement date. So let's say that you retire you're a general member, you're tier 2, and you retire at age 60. We're going to go general member tier 2, we're going to come down, we're going to match it with the age 60 row. 1.92% is the percentage that we're going to put in the formula for you. That is the percentage. You're going to get 1.92% of your highest salary for each year of service. Okay. Great question. So the question is, what if you're an age that isn't listed here? For example, 56. So the reason that there are some ages missing here is because I skipped a bunch of ages to make it fit on the slide. If this were the full chart, it would actually have increments for every quarter year, because the percentage increases every 3 months you don't retire, and it's based on your birthday. So if your birthday is January 15th, 3 months after your birthday is April 15th, 3 months after that is July 15th, 3 months after that is October 15th, then 3 months after that is back to your birthday on January 15th. And every time you pass one of those days, you go up one notch in this chart. And so if this were the full chart, it would say, for example, 55, 55 and a quarter, 55 and a half, 55 and 3/4, 56, and so on and so forth. And there would be a slightly higher age factor percentage for each one of those quarter year increments. So if you want to see all of those numbers, you can go to this page on our website. You can type this URL in, sarah.org/age, or you can just search for age factor percentages in the search blank and it'll pop right up. There's a PDF in there that shows you all of the quarter year increments for all of the tiers. One more thing that I would like to point out on this chart is that there is a maximum age factor that you can get for each tier, and that is represented in the blue box. So for example, General Tier 2, at age 65, the maximum age factor percentage is 2.43%. So if you retire 65 or 66 or 67 or 77, you're still going to just get that maximum age factor percentage of 2.43% in the formula for you. So the numbers stop going up once you reach the maximum. Okay, so that is pretty much all I have to tell you and all you need to know about the age factor percentages, unless you have any questions. Later on in the presentation, when I'm talking about choosing your retirement date, we'll revisit this idea so we can kind of like make sure you don't miss out on an age factor percentage. Okay, we're going to move on to the second factor in the retirement formula. So we talked about the age factor percentage. Let's talk about service credit. So you begin earning service credit when you enter a SARA. As soon as you're a member of a SARA and you start working, you begin earning service credit toward retirement. And you're going to earn service credit all the way up until you retire, until you stop working. If you go straight into retirement, it's going to be all the way up until your last day of work, and then your next day is your first day of retirement. But some people, there's a middle date in here where you stop working, you don't retire yet, and you defer your retirement to a later date. In that case, you would earn retirement up until you stop working. Bottom line is you earn retirement from your date of entry all the way up until your separation date from your employment. So you earn service credit during that time. You earn service credit while you work during your regular work hours. You also earn service credit during your earned vacation, sick leave, management leave, comp time, holidays, floating holidays. So none of those leave times count against you. You're already earning service credit when you're out on those leaves. Now you don't earn service credit during leave without pay, purchased vacation, which is where you purchase additional vacation more than your earned vacation. While you're out on that purchased vacation, you're not earning service credit. If you sell your vacation, so you're selling your earned vacation back to your employer to get cash, you don't earn service credit for it, but you may get salary credit for it in the retirement formula, which I'll go into when I talk about the salary portion of the formula. Additionally, you don't earn service credit for overtime, on-call time, or standby time. Okay. Now, just briefly, I'll tell you about service credit purchases. There are some types of time that you did not earn service credit for, but are eligible for you to purchase as a SARA service credit. And some examples are some part-time work that you did before your full-time retirement eligible position. And I'm not talking about temp work or work under contract, that doesn't count, but just like plain old part-time, that would be eligible for purchase. Or the county's temporary assignment pool if you worked there, or if you did some project work. So there's a bunch of different examples of those types of work that you can check out on our purchase page. Those days prior to entry, between your date of hire and your date of entry into a SARA, that 2 weeks, that's purchasable. Unpaid leave, where you're out on unpaid medical, disability, or military leave during your employment. When you return from that leave, you can buy that time. For medical and disability, it's up to 1 year per instance. Redeposit of prior memberships. If you used to have a membership with a SARA because you worked for the county or one of our employers, and you left and you took a refund of your contributions, and then you came back and you want to redeposit that money to get your service credit back, you could do that. Or if you used to work for a different agency in California and you're not eligible for their pension, you can purchase that for most public agencies as a SARA service credit. So I'm not going to take a deep dive into service credit purchases in this seminar. We talk about that in our new employee / mid-career seminar. And if you want to check out that information, we have videos of that seminar posted on our website on our seminars page. And you can also feel free to attend one of our live webinars. Okay. More information at our service credit purchase page on our website. One more thing I want to say about service credit is what happens to your unused sick leave? What happens to it? Well, if you go straight from active work into retirement. That means that your date of retirement is the next day after your last day of work or active employment status. So it's okay if you're on leave that day, if you're on sick leave, vacation leave, floating holiday, whatever. That's kind of your last day on payroll. So if that is the day before your retirement date, another way to say it is your retirement date is the next day after your last day on payroll, that means you're going straight into retirement. And if you go straight into retirement, we will convert your sick leave to service credit. You're basically going to get half of the sick leave you have left on the books as service credit up to a cap. Okay, now the cap can be found in your Memorandum of Understanding, your MOU. So you're going to have to read your MOU to find out what the cap is for you. And so we'll take all of the sick leave that you have on the books up to the cap, we'll divide it by 2, and you will receive that amount of time as additional service credit. To give you an example, in a lot of the MOUs, the cap is 125 days of sick leave. So if you had 125 days of sick leave on the books, we would divide that by 2, and you would end up with 62.5 days of service credit for that amount of sick leave. And that's work days, so that's not calendar days, that's work days. So just figuring a 5-day work week, that ends up to be about 12 plus work weeks, which is about a quarter year of additional service credit you would get in the formula for you when we calculate the formula. But this sick leave conversion does not change your date of retirement. I get that question a lot. It's just that we're going to add additional service credit to the number that we're going to put in the formula for you. So that's how that works. Any questions on service credit before I move on? Okay, seeing none, let me know if you have some later. We'll talk about the highest average monthly salary. So the third and final component of the retirement formula, or what we call factor, because we're multiplying it together to get your monthly retirement allowance for life. So your highest average monthly salary is going to be based on this period that we call your final compensation period. It's your period of highest pay during your career. For tiers 1 and 3, your final compensation period, your period of highest pay during your career, is your highest consecutive 26 biweekly or 12 monthly pay periods, depending on whether you're paid biweekly or monthly. For tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. Essentially, for tiers 1 and 3, it's your highest year of pay, so it's your highest consecutive year of pay. For tiers 2 and 4, it's your highest consecutive 3 years of pay. And this is assuming you work full-time. If you're working part-time during your period of your highest rate of pay, we'll find additional pay periods to tack on to get you to the equivalent of a 1 full-time year of pay and 3 full-time years of pay here. So working less time during this final compensation period does not count against you in terms of us calculating your highest average monthly salary. Okay, so we know what your final compensation period is. We know which period of your pay we're looking at. So what we do at Acera is we look at that period, we look at your payroll records from that entire period because we have all those on file so that we can do this calculation. Your employer has transmitted those to us. And our goal is to figure out what your average pay is over that period, your highest average monthly salary over that period. So we're going to take your total pay during that period for tiers 1 and 3, it's your highest year of pay, and we'll divide by the number of months in that period, 12 months, and that tells us your average monthly salary during that period. Pretty easy. For tiers 2 and 4, same thing. We take your highest 3 years of pay, we look at the total, we divide it by 36 months, which is the number of months in that 3-year period, and that tells us your highest average monthly salary. Now, what types of pay are included in that highest average monthly salary? So your base pay, of course, is going to be included. And for all of these types of pay, we're talking about gross pay. So this is before any deductions have been taken out. We're using the full pay. So base pay, and then for some people, you have other pay codes. These are sometimes called footnotes. Footnotes or other pay codes are often based on skills and education that you have. And there are many different pay codes. There's probably 1,000. And so I can't tell you off the top of my head whether one of your pay codes that you have is included in this highest average salary calculation and is going to count toward your salary, toward calculating your retirement allowance. But you can figure it out by going to this page on our website, sarah.org/pay codes, or you can just simply go to our website and search for pay codes. And there is a page that has a PDF for each of our 6 employers. You just pull up the PDF for your employer, and you can press Control F to do find. If you know your pay code's description or number, you can just scroll down through there and find your pay code, and it'll say yes or no whether it's in or out of this equation. It says yes, it's counted. If it's no, of course it's not counted. The one pay code that I can tell you that doesn't count is overtime. If you need help finding your pay code on the chart, you can ask your payroll manager for help with that. They can give you the number or the description. Okay. Now we're going to talk about these 2 other types of pay that may be included in your highest average monthly salary. Vacation sales and vacation cash out. Okay. Now, if you're in tier 4, you can take a snooze because this does not apply to you. And actually, I think currently tier 3 members, you're not allowed to sell vacation at all. And so that means that you can't do this either. So this would just be tier 1 and tier 2 members, unless sometime in the future, tier 3, Livermore Area Recreation and Parks District lets you start being able to sell vacation, and then you would be included in this. Okay, so you can chill out for a bit while we go through this topic. Okay. We're talking about you getting paid for your earned vacation. So you're earning vacation. That's one of your benefits, okay? If you don't take your earned vacation, they're going to compensate you for it. They're going to write you a check for it, okay? If you get paid for your earned vacation, and first let me talk about the 2 different ways that you can get paid for this earned vacation. The first is vacation sale or vacation sell. This is where you sell your vacation back to your employer. I think there's probably a form that you fill out. I'm not exactly sure how it works, but your payroll clerk can help you with it, and you tell them, I want to sell some of my earned vacation, and you sell your vacation back to the employer, and they write you a check for that vacation that you're not going to take. The other way that you could get paid for your vacation is called vacation cash out or vacation payoff, and this simply means that you still have vacation left on the books when you stop working and or retire. So you have vacation on the books that you haven't taken yet, that you earned and haven't taken. They will pay you for it, cash you out for that, or pay you off for that vacation at that time. So you'll receive a check for that vacation that you still had on the books. Now, so the vacation that we're talking about in this discussion is a combination of vacation sales and vacation cash out that you were paid during this final compensation period. Okay. And so we're going to look at the total compensation through a combination of sales and cash out that you received during this final compensation period. That's what we're looking at. So if you are paid for your earned vacation during this final compensation period, either through selling it or cashing it out, that means your total salary during your final compensation period goes up a bit. Because your total salary goes up a bit, that means your average salary over that final compensation period also goes up a bit. Because your average salary goes up a bit, and your average salary is one of the multipliers in the retirement formula, that means that your retirement allowance increases. So the bottom line is that if you sell vacation or you cash out vacation during that final compensation period, your retirement allowance is going to be higher. The reason I'm going through this in such detail is because this is what the law tells us to do. We must do this. If you are paid that vacation by selling it or cashing out during that final compensation period, we must include that in your retirement allowance. And because we have to do it, I might as well tell you how we're going to calculate it. So that's why I'm digging into detail here. So now I'll show you what the effect is on this slide of receiving vacation compensation during that final compensation period. So if you are in tier 2, just to give you an example, and you receive 8 weeks worth of vacation compensation during that final compensation period, that would make your retirement allowance increase by about 5%. These are approximate numbers, okay? A lot of people are in this situation where they are compensated for 8 weeks, their retirement allowance goes up by about 5%. So you can see it's a pretty significant increase. And because of the significance of the increase, and because people want to know, always ask a lot of questions about the nuts and bolts of it, it just makes sense for us to explain how it works, because the law tells us that we have to include this. A lot of people are in the situation where they can include 12 weeks of vacation, that would make your retirement allowance go up by 7.7% or thereabouts. Very few people, but there are still a few, are able to include 15 weeks. That would make your retirement allowance go up by about 9.5%. So it's pretty significant. For tier 1, it's a little bit simpler. It's compacted because we're only talking about a year's worth. So the compensation has a higher impact for tier 1. And I have a question: when is the final compensation period? So just as a reminder, the final compensation period is individual to you, and it's going to be based on your period of highest pay. So for tiers 1 and 3, it's your highest consecutive 26 or 12 monthly pay periods. For tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods, full-time pay or full-time equivalent. So that's when your final compensation period is. It doesn't have anything to do with the calendar year or the fiscal year. It's basically your highest pay periods that we have on record for you. And for the vast majority of people, this is like you're making your highest rate of pay at the end of your career. And so it's basically your last 3 years for tiers 2 and 4 and your last year for tiers 1 and 3. So if that was true for you, your final compensation period would be basically, we would look at your last day of work, and like for tier 2, for example, then we would go 3 years backward on the calendar, and that would basically be your final compensation period. Okay, now that I've showed you kind of the basic idea of the vacation being like increasing your retirement allowance and the effect of that, I have to tell you about what the limits are on this, because the law tells us that we can include this vacation, and in fact we must include some of this vacation, but we can only include it up to a cap that is specified in the law. And it's based on how much vacation you earn and how much vacation you're allowed to sell while you're still employed. It's based on those two numbers, earned and payable. Okay, to make this easy, I'm going to do this for you on your worksheet. The first people I'm going to address are the members who work for Alameda Health System, so employees of Alameda Health System. You look at this section on your worksheet, and I'll do everyone else in just a minute. So how you fill in this worksheet is you need to fill in this number, which is hours of paid time off, PTO, that you earn per pay period. So there's some number of hours you earn for each pay period of PTO. One of the possible numbers is this number right here, 6.7692. So you fill in that number, and then if you're in tier 1, you multiply this number by 26, and that gives you your limit in hours. If you're in tier 2, you multiply the number by 52, and that gives you your limit in hours. So that means that if you receive vacation compensation for up to this many hours, or this many hours, depending on if you're in tier 1 or tier 2, we can include all of that vacation compensation in as salary in the retirement calculation. If you're compensated for more than that, we can only include up to this amount of hours worth of vacation compensation. Okay, so let me do everyone else. Okay, let me see. Let me check on this question here. Okay, let me take that question in just a minute. So everyone else, you work for the county and the other employers, not Alameda Health System. You're going to use this section of your worksheet, and you're going to fill in these two numbers. The earned number is the weeks of vacation that you're earning per year at retirement. So if you're earning 3 weeks per year, or 4 weeks per year, or 5 weeks per year, whatever it is, you put in that number of weeks here. Okay, so let's say it's 5. You would put that in here. And this is the amount that you're earning at retirement. The payable number is the weeks of vacation that you're allowed to sell per fiscal year. This is a rule that your employer has somewhere. Maybe it's in their policies, written down somewhere. If you don't know what this number is, you can go ask your payroll clerk, or perhaps your HR department. So this is the maximum amount of vacation that they'll let you sell per fiscal year. So in weeks, so you write that number here. Then you're going to take these two numbers, and you're going to find your limit from this chart that I'm going to show you. So it's 5 and 2. So you take the earned number, and you work with that first, and you find 5 in this example. So you come down to this row, and then the payable number is 2 in this example. So then you would go to this sub row here, and then you come over here and find your tier. If you're in tier 1, your limit is going to be 4 weeks. If you're in tier 2, your limit is going to be 8 weeks. And that you would put into this spot in the worksheet. So let's assume that this person is tier 2, since most people are general tier 2 members, and we'll just stick with that example. So you put this number for you in the worksheet. Okay, now, if you want to maximize the amount of vacation compensation that will be included in the salary calculation, which I always get a lot of questions about, which is why I've included it on the worksheet. Here's how that works. All you need to do is, through a combination of selling vacation and cashing out vacation, you just get up to this number. So if you wanted to just cash out 8 weeks, you just have 8 weeks left on the books, you wouldn't have to sell any. You would have to sell 0. Okay. So you would just simply have 8 weeks on the books. That would get you up to the 8. Now, for the tier 2 members, let me tell you about this additional caveat here. Your employer has this rule where they will not cash you out for more than 2 times your accrual rate of vacation. So let's take a different example. Let's say you earn 5 weeks per year, but you're allowed to sell 3 weeks per year. Okay, so your limit from the chart is going to be 12. Now, this rule says that your employer says they will not cash you out for more than 2 times your accrual rate. So in this example, you're accruing 5 weeks of vacation per year. 2 times 5 is 10. So if you have 10 weeks of vacation on the books, they will compensate you for all of those weeks of vacation. If you have 11 weeks or 12 weeks, 13 weeks, anything over 10, you just lose it. It goes poof, disappears. You don't get to take it. You don't get compensated for it. You don't get credit for it in the Sarah's formula. So to avoid that, what you would do is, and if you're trying to get up to your limit in this example, that is when you would want to sell some weeks of vacation. Because in this example, this person can't cash out more than 10. That is against the employer's rule. And so in order to get up to the 12, they would actually have to sell 2 weeks of vacation during that final compensation period. So that's how that works. Now, to go back to the previous example, this person does not have to do that because their limit for the 2 times accrual rate is still 10, but their limit from the chart on how much vacation we can include it as salary in the pension calculation is only 8. And so they can easily get up there just simply by cashing out, and they don't have to sell any. It's only if this limit is bigger than 2 times your accrual rate, that's when you have to think about selling if you're trying to get up to this number. So if you can't get up to this number simply by cashing out, then you have to sell. Okay. Now, sometimes I get the question, what if I already sold a bunch of vacation? So I didn't quite know about this. I've been selling because a lot of people have been selling vacation. There was like kind of this old way of doing it where you sold vacation every year for your last 3 years if you were in tier 2. So if you sold a bunch of vacation, you have 2 options. Option 1 would be to cash out the difference. So let's stick with your limit from your chart is 12, and you've already sold 6 weeks of vacation during that 3-year final compensation period for tier 2. So at some point in that 3 years, you sold 6 weeks of vacation. So in order to get up to the 12, you would really only need to cash out 6 more weeks of vacation. So all you do in this method, this option, is you look at how much you've sold, and then you simply cash out the remainder. And that gets you up to your limit. Option number 2 is you can cash out more than 2 times your accrual rate, and that's totally okay. So in this instance, we'll stick with the idea that you sold 6 weeks of vacation. And when you sold that 6 weeks of vacation, you got all the money for that 6 weeks. That went to your bank account. Okay, now it's time for you to retire. And then what happens is you have 10 weeks on the books that you haven't used yet. And so you get cashed out for that too, because that is up to that limit of 2 times your accrual rate. So you're going to get 10 weeks worth of pay for that 10 weeks worth of vacation. You get all that money too. That all goes to your bank account. Okay, so that's 16 total weeks of vacation pay that that were deposited into your bank account. Now, like I was telling you earlier, the law tells us that we have to limit how much of this vacation pay we can include in the salary calculation by this number based on, I mean, in this example, it's 12, but it's, individual to you based on how much you earn and how much is payable to you. And so what we would do is we would take the highest 12 that you were paid from the 16 that you were paid. And 99 times out of 100, the 10 weeks that you cashed out, you got more money for because of cost of living adjustments and raises. You were earning a higher rate of pay at the end of your career versus like 3 years ago. And so we're going to take these 10, and then we're going to take 2 weeks of vacation from here to add it to that 10, whatever the highest 2 are. And that is the 12 weeks worth of vacation compensation that we will add to your base salary when we're calculating your salary. So that's how that works. Okay, so then I have this question. What if you worked, basically the question is, what if you just, instead of cashing out or selling this vacation, what if you just worked that amount of weeks instead? Instead of getting compensated for it by selling it or cashing it out, you worked it. Okay, you can do that. So in that scenario, let's say that since we're looking at this slide, let's talk about 12 weeks as an example. Okay, let's say in this example, you, instead of getting paid for the 12 weeks, you just worked the 12 weeks. You worked, or I'm sorry, um, you worked it sort of, but you took it as vacation leave. So you just kind of tacked on 12 weeks of vacation leave onto the end of your career. Okay, what that would do is when we're looking at the formula, you would get 12 more weeks of service credit. That would make your service credit number go up. But it would not make your salary number go up because you're not getting like kind of extra salary credit. You're not getting salary extra credit for that 12 weeks. You're getting 12 weeks of service credit. Okay, so that's one way to do it. Now, the other way to do it is by getting the salary credit for it. You're not taking it as service credit, so that service credit number stays the same, but the salary number goes up. The answer is that this, doing it the salary method, will by far increase your retirement allowance way more than you would if you got service credit for it. Because the service credit part is just like 3 more months. It's just like, a few more weeks of service credit. The salary credit part is like getting extra pay periods on top of the salary that we're already including in the calculation for you. You're going to get way more of a boost doing it the salary method by selling vacation and or cashing it out. Okay, so before we welcome back the Tier 4 members, what else, what questions do you have about this topic? Okay, seeing no questions. Basically, when you fill out your worksheet, just go ahead and fill it out in this manner. And if this is something that you're planning on, what you could do is, like, once you establish your limit, then you could kind of put your plan in here, like how much vacation you're planning to cash out, how much vacation you're planning to sell. Okay, Tier 4 members, welcome back. Sorry that we had to go into that much detail about that and take so much time, but um, it's important details. Okay, the next topic are, and I'll just touch on this briefly, there are some benefit limits on your retirement allowance. Most of them don't apply to most people, but I'll just go through them really quickly. The first one is that your highest average monthly salary that your retirement allowance is capped at 100% of your highest average monthly salary. The idea here is that so you're not making more in retirement than you were making as a working employee. And it sort of works out that way, except like we were just talking about, your highest average monthly salary can be a bit higher, with that vacation added. But so that's the cap on that. Most people don't hit that because for Tier 1 members, you need like at least 35 years of service credit and you're a certain age. For Tier 2 members, it's like over 40 years of service credit and a certain age. And most people retire with 20 years of service credit, so on average. So most people won't hit this limit, but some people do. The good news with that is that even though it's capped, that means that you're making the same amount, basically in retirement that you were making it while you were working. So that's a beautiful thing. You achieve 100% income replacement. Okay, the next two are limits for people who have very high salaries. And so if that is you, I'll just let you read that information on your own because it does not apply to most people. The last limit is for Tier 4 members. Tier 4 members, your highest average monthly salary on an annual basis is capped based on the Social Security wage index limit, and it's these two numbers here. 126,291 for general, 151,549 for safety. Actually, I happen to know that those numbers increase every year, and they just increased. So these are actually the 2020 numbers. The 2021 numbers are out on our website. And so these increase every year. It means that we can't include any more salary than this amount when we're doing the salary calculation for you. So that kind of limits, the amount of retirement allowance you can get for the Tier 4 members. On the other hand, the good news is that we don't collect retirement contributions on any amount that you earn over these amounts per year. And so that gives you more money in your paycheck to save in investments or in your 457B account. Okay. So let's talk about estimating your retirement. Okay, now I'm going to show you how to get an estimate of your specific retirement in two different ways. First, I'm going to show you this ballpark estimate. So you think about your retirement scenario and you think, what age will I be in that scenario? You put that in here. How many years of service credit will I have at retirement in this scenario? And you put that in here on your worksheet. Then you're going to need to go out to our ballpark salary table. You can go to this URL, or I'll show you where to get it on our website. So here's our website again. And the best place to get this from the home page, you can either go new to Acera here, or you can just click this Get Started button. Scroll down, and you'll see that there are these buttons right here. And the question is, how much will your pension be in retirement? This is helping you do that ballpark scenario. So I'll click on the General Tier 2 table, and you can see that across the top of the table, there are various ages that you might retire at. And down this column are different years of service credit that you might retire at. So we were considering the scenario where you are retiring at age 58 with 29 years of service credit in that example. So what I'm going to do is come down to 29 years. I'm going to go over to age 58. And where those intersect, I see 50.03%. That means that in retirement, just as a ballpark figure, I'm going to get 50.03%, essentially 50% of my highest salary as my retirement allowance. So I take that 50.03%, I come back to the worksheet, I put that in here, and then what I need to do is simply take my salary that I'm earning and figure out and multiply it by the 50%. So you can just kind of, it's because this is a ballpark estimate, you can just kind of think what you're earning per month. I mean, if you want to do it more precise, you can log into our website and use our benefit estimator, and it will give you a projection of your highest average monthly salary. But if you're already in there, you might want to do the precision estimate anyway. So this is just kind of a ballpark where just say I'm earning about $6,000 per month. 50% of that is about $3,000, $3,001. So that's just kind of how the ballpark method works. Okay, now we'll do the precision estimator. You go to this section on your worksheet, and what you're going to fill in this section first are the separation date and projected retirement date. Separation date, which is also known as termination date, is your last day of work for your employer. Projected retirement date is your first day of retirement, and it has to be at least the next day after your separation date. Okay, so you're going to think about your retirement scenario, and you're going to think about what these two dates might be for you, and you put those in here. Now we're going to come out to Acera's website, and I'll show you some screenshots of how this works. And you log in to your account on our website by pressing this button and logging in. If you've never done that before, you have to create an account and answer some security questions to be able to create an account and get in there. But once you get in there, you'll find that all of your pension data is there waiting for you. So once you log in, the first screen you're going to see is this account summary screen. And this shows a lot of the pension data that we have for you, such as your date of entry into Acera, or the amount of years of service credit that you've earned, or how much you've contributed to Acera's fund. What you're going to do is click on Estimate a Benefit. So this is our benefit estimator tool. And you're going to put in your separation date and projected retirement date here. If you know you're going straight into retirement, just pick 2 days where the separation date is the day before the projected retirement date, and use that. But if you're going to defer your retirement, you're going to stop working and defer your retirement to a later date, you can do a scenario like that as well. Okay, so I'm just going to zoom in here so you all can see a little bit better. We have 2 dates in here for the year 2030 in this scenario. And we're going to hit calculate. And what it's going to do for you is project how much service credit you will have earned in this scenario. And it will also give you a projection of how much your highest average monthly salary is going to be that we're going to use in the formula for you. Now, highest average monthly salary, another synonym for that is final average monthly salary. Okay, so it's going to do those 2 numbers. And then you have the opportunity, if you want to, you can override those 2 numbers. You can override the service credit number. For example, if you want to see what the effect of that sick leave conversion is, and you know that you're going to get like a quarter year more of service credit, you would simply add a quarter year, because this is measured in years. So you would add 0.25 to this number and put the new total into this blank. You can also override your salary. If you want to. The reason you might do that is, maybe you're not going to retire for a few years, maybe 3, maybe 5, maybe 10. And this is using your current salary. It's not like projecting increases in salary. It's using your current salary to make this, kind of calculated projection. We call it projected, but it's not projecting increases. And so you might want to add like inflation over a few years to the salary figure and see what the effect of that is. It's all up to you. If you want a nice conservative estimate, you just don't change the numbers. You do also have the option of adding hours of cash vacation compensation in here, and that would give you an idea of the effect of selling vacation, like having this vacation sales and vacation cash out included as salary in this calculation. And I'll actually show you how to do that without overestimating. Okay. And so what you do is you just hit get estimate, and then you end up with a, you can put in beneficiary information here if you want, and you hit get estimate, and you end up with just a basic benefit estimate PDF. Now, the reason I'm not showing you the PDF yet is I'm actually going to show you how to do this blank without overestimating. So step 1, and you'll find this section on your worksheet. Step 1 is you run an estimate and you leave that field blank. Okay, so you're running an estimate, you're leaving this field blank, you're hitting get estimate. Okay, and you'll end up with a PDF, and I'll show you that PDF in just a minute. Okay, and so on the worksheet, what you're going to fill in here is your limit of how much vacation we are allowed to include in the salary calculation for you in weeks, right here. And that's just from the other section of the worksheet. You just take that number and fill it in over here. Okay, that's for everyone except for Alameda Health System. Alameda Health System starts here. Now, for everyone else, this is measured in weeks. What we need to do is get it measured in hours. And so if you work 40 hours a week, you put 40 in. If you work 37 and a half, you put 37 and a half in. And you multiply them together, and that tells you your limit in hours. AHS people, you already know what your limit is in hours. So you can go ahead and put that in here. And that's where you start. Okay, now we know what your limit is in hours. So what my goal here with this section of the worksheet is to help you not overestimate if you've already sold vacation during your final compensation period, because that's already going to be included in the salary estimate. So what you do is you run the estimate and leave it blank, okay? And then you're going to try to figure out what this number is, hours of vacation sold during the salary date range. So you go to that estimate, here's your benefit estimate, and what you're going to look for is a few numbers. You look at this salary date range. This is the date range that it's using to make your salary projection, and you think back, did I sell any vacation during that time? If so, how much? in this example, let's say that I think back to that and I remember, oh yeah, I sold a week's worth of vacation. I work 40 hours a week. I sold a week's worth of vacation. So I sold 40. So what our goal is to subtract out what I've already sold from my limit. So you just subtract that number from this number and you end up with 56 for the blank. And then you would put 56 here. Now, just to go back one slide, if you haven't sold any during this date range, you think back, oh, I didn't sell any during that date range. Then you would just simply put in your limit. Okay, so then you would put in 96 here. So what I'm doing with that part of the worksheet is just helping you not overestimate. And like I said, that's all optional. If you want a nice conservative estimate, you can just leave this blank. So you can hit get estimate, and this is your precision Acera retirement benefit estimate using our precision software. So I'll just zoom in on it a little bit so you can see it a little bit better. This stuff up here is kind of the demographic info and data that it's using to do the calculation. This box down here is your benefit estimate. It shows you a benefit estimate for each one of the retirement options. We haven't talked about the options yet. So if you don't know about those, we'll talk about those later on in the presentation. But for right now, you can just look at this number because the unmodified option pays the most retirement allowance to you, the retiree. And so you can just kind of go by this number. This is your retirement allowance estimate. So that's how you get a precision estimate. And if you want to, you can take that number and put it back in here. And if you wanted to fill in this hours of cash vacation compensation, like just to keep track of how many hours you put in the calculator, you can fill that in here. So in that example, it was 56. And so you would put that in here. And then later, when you come back and look at the worksheet, you can go, oh yeah, for this scenario where I was doing separation date, projected retirement date, this is the estimate I got. Okay, so that's two ways to get a Acera retirement estimate, the ballpark way, the precision estimator way. There's a third way, which is that you can file with us a retirement estimate request. You can actually send one in when you're logged into Acera's website. There's a form in there. It's an electronic form and you can do it. Or you can fill out the retirement estimate request form on our forms page. And you simply submit that to us. One of our representatives, one of our benefit specialists will do the calculation for you, and they'll send you a letter in the mail telling you what your benefit estimate is. Now, when you do it that method, there's a wait because we get a lot of these requests, and so there's sort of a queue, and it's kind of based on how far out your estimate is. So it could take a little bit of time, some days or weeks, to get that letter back. Whereas if you do it with the Precision Benefit Estimator in your account, it uses the same software that our benefit specialist is going to use and the same math, so you're going to get the same results. And that is available 24/7, and you can do that estimate within like 5 minutes. So that I highly recommend using that method. Okay, so we have talked about getting your estimate. So we've checked that off the checklist. The next item on the checklist is verifying your retirement eligibility. So let's go ahead and do that. We're talking about this milestone right here, the retirement eligibility milestone. So this is going to be individual to you, and so there's a few different ways that you become eligible to retire. So I'll show you tiers 1, 2, and 3 first, and then I'll show you the slide for tier 4. So if you're in tiers 1, 2, and 3, you have 3 ways to become eligible to retire. Hang on one second. Option 1 is that you are over age 50 and you have at least 5 years of service credit and at least 10 years of membership with Acera, and that makes you eligible to retire. Now, I'm not sure why this 10 years of membership rule happened sometime way in the past, but it means that if you're going to work through your career and go straight into retirement, you just kind of think about 10 years and age 50. because you would earn the 5 years of service credit, yes, but then you'd work another 5 years and earn 5 more years of service credit. You'd have 10 years of service credit, and you retire at age 50. Some people don't do that, though. You can just get over the 5-year mark. You could stop working, and then you would just have to wait another 5 years until 10 total years has passed between your date of entry and the time you're trying to retire. As long as you're over age 50, then you're eligible to retire. Okay. So that's option number 1. Option number 2 is that for general members, you can have 30 years of service credit, or for safety members, you can have 20 years of service credit and retire at any age, even if it's younger than age 50. Now, if you're already over age 50 and you're getting close to these numbers, then you're already eligible to retire. Option number 3 is that you can be age 70 and retire with any amount of service credit, even if it's less than the 5 years of service credit that you need to retire in option number 1. So those are your 3 ways that you become eligible to retire in tiers 1, 2, and 3. Tier 4, there's 2 ways to become eligible to retire. The first is that you're a general member and you're at least age 52, or you're a safety member and you're at least age 50, and you have 5 years of service credit, 5 or more years of service credit, and then you can retire. You're eligible. You don't have to do that 10 years of membership thing for tier 4. And then your other option, again, is the option where you're age 70 and you can retire with any amount of service credit, even if it's less than 5 years. So that's how you become eligible to retire. So it's pretty basic. And going back to your career timeline section in your worksheet, now that you know what your retirement eligibility date is, if you're not already eligible, you can fill that in here. If you just know I've been eligible for years or whatever, I know I'm already eligible, this isn't a big deal. So you can put that date in the worksheet or not. Okay, next item on the checklist. Let me help you choose your retirement date. I'm going to help you by helping you think of these different topics. We're talking about this item on the pension milestone chart, your retirement date. These are all the things that you're going to want to think about when you're choosing the best day to retire. It seems like it's a long list, but it's not that complicated. So let me help you through each one. Okay, this one, will you have enough income? This is sort of optional. I mean, if you already know you're eligible to retire, whether or not you want to think about this, it's up to you. It's a good idea to at least have an idea of what your income is going to be after retirement. And a good way to do that is to get that ACERA retirement estimate. I recommend using the Precision Benefit Estimator in your ACERA account. I'm also getting an idea of your other savings. So if you have a deferred compensation account, a 457B account with the county, it's a good time to log in there, see how much you have in there. Or if you have other investments, it's a good time to take stock of what your savings and investments are. And also use the Social Security website estimator to get an estimate of what Social Security is going to pay you when you become eligible to receive that. And this just kind of gives you an idea of what your income is going to be after retirement. And then if you want to, you can kind of think about your post-retirement expenses and kind of think, is my income going to be adequate to pay those post-retirement expenses? And if not, maybe I need to earn a tiny bit more retirement. That's up to you. Financial planners will tell you that you need 70 to 80% of your pre-retirement income to maintain your standard of living in retirement. So whatever you were making before you retire, they say you need 70 to 80% of that in retirement. This is kind of like a super quick explanation of this whole idea. We do have a whole page on our website that covers this topic in more detail. Let me show that to you. To find that, from our homepage, you scroll down to Ready to Retire, and there's a Prepare to Retire section. And that is right here, Estimate Your Retirement Income. And so it's a little more detailed take on getting an idea of whether you're going to achieve that 70 to 80% income replacement. And there's even a calculate your expenses in retirement worksheet here that you can try out. So that's up to you. Okay. The second thing that you're going to want to think about when choosing your retirement date, and that you may want to think about, are these age factor percentage dates. So remember, during the first part of the presentation, I said we're going to kind of return to this topic. That's now. So if you recall, if you are younger than the maximum age factor age for your tier, every 3 months that you don't retire based on your birth date, you're getting a higher you're going one notch up in that age factor percentage chart, and you're getting a slightly higher age factor percentage that we're going to use in the formula for you. And so what I'm going to do with this slide is just try to help you manage those dates. So to give you an example, if your birthday is January 15th, 1 quarter after your birthday is April 15th, 2 quarters after your birthday is July 15th, 3 quarters is October 15th, and then back to your birthday. So let's say that let's say that you are you haven't yet reached the maximum age for your tier, and you're considering retiring in this example on July 16th. Let's say that you are considering retiring on July 14th, to give you an example. Well, you can obviously see that you don't want to do that, because if you just wait a couple of days, you work on July 15th, you retire on July 16th, you're going to go up one notch in that age factor chart, and you're going to get a slightly higher age factor percentage. And in fact, your retirement allowance is going to go up by a little over 1% just by waiting those 2 days. Okay. Same thing with all of the other dates. So to get past the day, you work on that day and you retire at least the next day after that day, and that gives you the next highest age factor percentage. Now, this is only really important if you were going to retire right before one of these days. If you're going to retire like halfway in between these 2 days, maybe you don't want to work another 6 or 7 weeks to get over this day. You're ready to retire now. That's totally fine. All I'm trying to illustrate with this slide is I don't want you to retire directly, within a few days or a week before this date. I want you to get past that day so you get the next highest age factor percentage. Okay. The next thing that you're going to want to consider is a Sarah's cost of living adjustment. The cost of living adjustment is an annual increase to your retirement allowance, and it's calculated annually based on the percentage increase of the consumer price index in the San Francisco Bay Area. It's just a measure of inflation. If inflation goes up a certain amount from December to December, that becomes the cost of living adjustment for the next year, which is posted on April 1st. So everyone who's in retired status, and this should actually say as of April 1st. I need to correct that. Your first day of retirement can actually be April 1st. And you would get the cost of living adjustment for that year. Now there's a limit on how much increase we can increase your retirement allowance by. For tiers 1 and 3, it's 3%, and for tiers 2 and 4, it's 2%. But what happens if inflation from December to December is more than that? Let's say like it's 5%. What happens to the extra percentage points? Well, we'll save those for you. We're going to save those for you automatically in your COLA bank. And then in future years, when inflation is less than these maximums, so let's say like it was 5% one year, then we gave tiers 2 and 4, 2% increase, and tiers 1 and 3, 3% increase on April 1st that year. And we banked percentages for the future. And then the next year comes around, and let's say inflation is only 1%. We'll take percentages out of your COLA bank and apply it to the 1% to get you up to your max annual limit. You don't have to remember any of this. The main takeaway from this is that since inflation tends to be a little more than 3% in the US, people tend to bank percentages, and you tend to get your maximum annual limit, especially if you've already been retired for a few years. The other takeaway is that the cost of living adjustment is posted on April 1st of every year. And so if you're going to retire in the springtime, you would want to retire on or before April 1st to get the cost of living adjustment for that year. Otherwise, if you retired on April 2nd, You would miss the cost of living adjustment for that year, but you would get next year's cost of living adjustment when April 1st comes around. So some people ask, what happens if there's a conflict between the age factor percentage and the cost of living adjustment? And this is really only if you're retiring in the springtime. So we'll stick with the January 15th birthday example. And this person is still under the maximum age factor for their tier. So with every quarter year, their age factor percentage is still increasing. So the dilemma is, in this example, should I retire on April 16th? And if I do that, because I passed April 15th, 1 quarter after my birthday, I would get that next age factor percentage increase, but I would miss the cost of living adjustment for that year. Or should I retire on April 1st and I'll get the cost of living adjustment, retiring on or before April 1st, but I'll miss the age factor percentage increase that I was going to get if I had retired in a couple of weeks on April 16th or beyond. Which do I do? And the answer you probably already figured out because I already told you the percentages. If the cost of living adjustment is the maximum that year, and we always know that in early February, you go with the cost of living adjustment because that's going to increase your retirement allowance by 2 or 3% immediately versus the 1% increase you're going to get for the next highest age factor percentage. So there is a, even if you've already reached the maximum age factor percentage for your tier, there is a time after April 1st where it would have been more advantageous for you to retire on or before April 1st, which is why March is our biggest retirement month of the year, because everybody's already ready to retire and they're thinking, well, I'm just going to go ahead and do it because I'm going to get that immediate cost of living increase by retiring on or before April 1st. But because as you work more, you keep earning more retirement, more credit toward retirement, that situation is going to quickly resolve itself. So in the couple of months after April 1st, maybe like 2 months goes by, if you retire then, you're going to earn more in retirement than you would have had you retired April 1st because you're continuing to earn service credit. And then especially if you pass this age factor increase day, and then if you passed another age factor increase day, like in July, that would be the cost of living adjustment. And the last thing I'll say about the cost of living adjustment is that if you're not going to retire in the spring, you don't really even worry about the cost of living adjustment date, because when April 1st comes around, you're going to get the cost of living adjustment, and you're going to get it every year for the rest of your life, okay? Because it's one of the vested benefits. And also, if you're already reached the maximum age factor percentage for your tier, then you don't even have to worry about those quarter year dates. So you just retire whenever you want. Okay, the next thing that you're going to want to think about when choosing your retirement date is you're going to want to retire on the, if you want us to do the sick leave conversion for you, you're going to want to get where you want to get service credit for your sick leave. You want to make sure that you're going straight into retirement. So I already showed you this calendar graphic earlier in the presentation when I was talking about the sick leave conversion. You want to retire on the day after your last day in active payroll status. This is known as the date of separation. And it's your last day of work or active employment status. And you can be on leave on that date of separation. Like maybe you're on vacation this whole week, or maybe you're out on sick leave this day, or you're using up a floating holiday before you go. That's totally fine. You're just going to want to have your first day of retirement be the next day after your last day on active payroll status. Okay. And then we will do that sick leave conversion for you automatically. The next thing that you want to think about is kind of similar. You want to retire on a non-holiday day where you are scheduled to work the day before. Okay, let me see if I have another graphic. No, I don't have another graphic on that. So the example is, if you work Monday through Friday, you don't want to retire on Sunday or Monday because you're not normally scheduled to work on Saturday or Sunday, which is the day before Sunday or Monday. And if you were to retire on Sunday or Monday, that would mean that there's that day in between where you're not scheduled to work, and you would be deferred on that day. And if you're deferred for even one day, you would lose all your sick leave, and we wouldn't do the sick leave conversion for you. Okay, so you want to make sure that your first day of retirement is a non-holiday day where you are scheduled to work the day before. So this day right here, this should not be a holiday, and this day right here, you should be scheduled to work, even if you're scheduled to be on leave. Now, and it doesn't have to be Friday and Saturday. It could be, any of these days. For those of you who don't work Monday through Friday, like sheriff's deputies and people in the medical professions, maybe you have an irregular schedule. And maybe if you're planning out a few months, you don't know what your schedule is going to be during, the time period, like you kind of have an idea of when you're going to retire. Maybe you don't set your retirement date exactly until it gets closer to the time. And then when it gets closer to the time and you see what the schedule is going to be, let's say that you're scheduled that week, Monday through Wednesday. Well, then you would want your first day of retirement to be either Tuesday through Thursday, because you want to be on the schedule the day before that. And that way you can go straight into retirement. So that's another little caveat for choosing your retirement date. The last and final thing to know about choosing your retirement date: don't retire on July 1st. Pick any other day. The reason for that is that if you are one of those people who is trying to max out how much the amount of vacation compensation that can be included in your salary calculation, all the limits that I've showed you in the presentation will be lower if you retire on July 1st. And it has to do with lining up with the fiscal year, and it's like a whole complicated thing. You don't really have to worry about why it is. Just don't retire on July 1st, even if you're not doing the vacation stuff. Just pick any other day. June 30th is a beautiful day to retire. July 2nd, really excellent day to retire. Just don't retire on July 1st. Okay, so back to the worksheet and the career timeline. If you have a better idea now of what your projected retirement date is going to be, you can feel free to fill that in. Additionally, if you know that you want to go straight into retirement, now you know your separation date should be the day before that. So that's easy to fill in. So you just subtract one day and put that here. Okay, that's choosing your retirement date. Now we'll address the section of the checklist about applying to retire. What is that process going to look like? The first step in the retirement application process is we ask you to go through our Preparing to Retire section on our website. So you can find that at acera.org/prepare. I'll show it to you in just a second, but it talks about different documents we need to have on file for you. Changing your web member services username, that's your Acera account, to your personal email address rather than your work email address. Notifying your department of your termination date, like resigning, and so on and so forth. There's a bunch of stuff in there. If you can go to this page. I already actually showed you where to get to that section. I'll show it again. You can get to it in two ways: under members, preparing to retire, or you just scroll down on our homepage, prepare to retire. And it's in reverse chronological order, so it starts with the things you'll need to do first, and then it kind of goes in order from there. And so there's just a few different articles on here to cover. Step number 2, set up a ready to retire counseling session. And so you're going to submit a form on our website to set that up. We ask that you do that in the 3 to 6 months. So that in the 6-month period before you retire, we want you to do it sometime in that first 3 months. So 3 months before you retire to 6 months before you retire. Um, and so what that looks like is back to the preparing to retire section on the website. That is one of the final things that you do, and it's right here: schedule a ready to retire counseling session. And you just go through and you fill out this form. And once you fill out the form and submit it, one of our representatives will contact you to schedule that counseling session. And that counseling session will take place, we'll schedule it for the 60-day period before your retirement date. So on the form, you're going to tell us when you're thinking about retiring, and we'll schedule it for within the 60 days before you retire. Also, within that 60-day period, you're going to submit a retirement application. And there are instructions here, but if you contact us, we will also direct you on how to, if you do go through this process of submitting this form, we will also kind of direct you on how to do that. And we're getting ready to actually create a seminar that is about filling out your retirement application. So you're going to submit your retirement application during that period, and you can submit it during the counseling session so that your counselor will help you submit it. Additionally, there's this option election agreement, so you're going to select one of 5 retirement options. Currently, the process is that you receive that option election agreement 2 weeks before your counseling session. If you're watching this a couple of months from now, we're going to combine the retirement application and this option election into one form. So it'll look a tiny bit different, but it'll be easy to understand. But the bottom line here is that during that period leading up to your retirement date, you're going to choose one of those 5 retirement options. You're going to make that election. And you're also going to submit that retirement application. Okay, so on this retirement application, you're telling us what your retirement date is going to be. Once you submit it to us and that date passes, you're retired. Woohoo! It's amazing. You're going to be able to take advantage of all of the retirement that you have earned throughout your career. And you're going to get to relax and do whatever you like. So that's going to be a good day. And we are here to help you get there. So now on your worksheet that you know when to go ahead and submit the form, it says to call. I need to update that. You should submit the form to go to the Ready to Retire counseling session. All you do is, since you should do that kind of 6 months ahead of time, you just subtract 6 months from your projected retirement date, and that's when you should go ahead and submit that. But like I said, it's within that 3 to 6 months before your retirement date. Okay. Once you're retired, you can expect to receive your first retirement check within the 4 to 6 weeks after your last employer paycheck. And because it's a monthly check, you're going to get your check on the last business day of each month. And it's going to be a direct deposit after the first check. If there are any major issues with your file, you're going to get 80% payments, what we estimate to be 80% of your final retirement allowance, until those issues are resolved. And then we'll get you up to your 100% payments and then provide any retro payments for any less than 100% payments that we made. The vast majority of people these days don't have any major issues because we're having you submit, we're having you do this counseling, set that up 6 months ahead of time, and that starts getting the gears going of us being able to process your retirement. And so we can get, for the vast majority of people, we get you right onto 100% payments. Okay, now is the portion of the seminar where I show you the 5 retirement options. So like I said, you are going to choose one of these options on that election form. And this is, at the time of retirement, is your one opportunity to make this selection. You can't pick a different option later. So it's good to know what the options are now, so you know to pick the right option, because you can't change it later. For each one of these options, I'm going to show you a slide that has a table on it, and the top row is going to talk about your retirement allowance. The bottom rows are going to talk about death benefits that your beneficiary or beneficiaries will be able to receive upon your death. Okay, so I'll show you a slide for each one of these 5 retirement options. There's there's the unmodified option and options 1 through 4. Okay, so let's talk about the unmodified option. The unmodified option pays the highest retirement allowance out of any of the options. And this is why most people select this option, because it pays the highest retirement allowance. So after your death, what this leaves to a beneficiary, and a beneficiary, that word simply means somebody who gets benefits, somebody who gets paid a benefit. And in the context of a SARA, it's somebody who receives your SARA death benefits. So your SARA beneficiary is the person that you designate to get your death benefits. So if you choose the unmodified option, and you have a spouse or state registered domestic partner who you have married or registered at least 1 year prior to your retirement, they will get a 60% monthly continuance. Now, a continuance, that word, it just means a continuing payment. So up here, while you are receiving your retirement allowance, you're getting a monthly payment. And then after your death, your spouse or state registered domestic partner will also receive a monthly payment for the rest of their life. And it'll be 60% of whatever you were getting at the time of your death. And they will also get cost of living increases. If you have a service-connected disability retirement, that amount goes up to 100%. Okay, now if you don't have a spouse or state registered domestic partner, but you do have a minor child or minor children, they can also get a 60% continuance, but it's not for the rest of their life. It's temporary, and it stops at age 18. Or it can continue until age 22 as long as they maintain enrollment as a full-time student in an accredited school, and then it will stop. Or it will stop if they get married or they register a state domestic partner with the state, and then it will stop. Okay, so that's all about the continuance part of it. Now, alternatively down here, if you don't have a spouse, state registered domestic partner, or minor children, that doesn't mean that you can't select the unmodified option. You can still select the unmodified option, get the maximum retirement allowance. And you can still name a beneficiary. It just means that whoever you name will not be eligible for a continuance. They will be eligible for a one-time lump sum payment of a death benefit. So it's like a one-time lump sum amount. And the amount is going to be the balance of your contribution account. So however many contributions you've paid into a SARAS fund, we're keeping track of that, plus in your account, plus we're keeping track of the interest that we've paid to that account. And then the benefit is going to be minus any of the retirement allowance that we've already paid out of that amount, out of that contribution account in your retirement payments while you're getting your retirement payments. So one thing I will say about that is that there's not going to be a balance in there after the first 3 to 5 years of retirement. So if you have a lump sum beneficiary, there's not going to be a lump sum amount in your contribution account after the first 3 to 5 years, because that account will be exhausted. We will have given you back all of your money. The good news about that is that means that all of your contributions that you paid into a SARA, plus all the interest that you've earned throughout your entire career, we give you all that money back within your first 3 to 5 years of retirement. And then everything that you receive after that for the rest of your life, because it's a lifetime monthly retirement allowance, is like a pure bonus for you that you've earned by participating in the defined benefit pension plan. And where the way we're able to do that is partially from the employer contributions, but the most of it comes from the interest that we've earned by professionally investing your contributions over the many years that you've been working. And in fact, 75% of your lifetime retirement allowance comes from that interest. So it's really advantageous that you're able to participate in a defined benefit pension plan like a SARA. It's a really special thing. Okay. One more thing I'll say about the unmodified option There is a scenario where at the time of retirement, you had a spouse, say registered domestic partner or minor children, that you named as a continuance beneficiary, but they die before you do while you're retired. That happens, you can name a new beneficiary, but only for lump sum payments. The only time that you have the opportunity to name beneficiaries for a continuance is at the time of retirement. That's the unmodified option. Option number 1 is the only one of the options that never pays a continuance to anyone at any time. This only pays lump sums to your beneficiary. So to you, the retiree, it pays a little bit less than the unmodified option. To your beneficiaries, what it will do is extend the time that it takes for your contribution account balance to be exhausted. Rather than 3 to 5 years, it's going to be the first 10 to 12 years. So if you happened to die within the first 10 to 12 years of retirement, hopefully that does not happen. But if you did, there would be a balance in that contribution account left over to pay to the lump sum beneficiary. And you can name anyone as a beneficiary. That's option number 1. Option number 2 pays 100% to your beneficiary. So what this option does, it does a couple of things. The first thing that it does is it provides a 100% continuance to your beneficiary. So whatever you are making at the time of retirement, whatever your retirement allowance is, your beneficiary is going to get that same retirement allowance after your death. So that's why it's a 100% monthly continuance. The second thing that option 2 does is it expands the group of people that you can name as a beneficiary for a continuance. It's not just spouse, state registered domestic partner, and minor children, it's anyone. So you can name anyone for a monthly continuance. Now, the caveat here is that this is going to pay less than the unmodified option, and the reduction is going to be based on your beneficiary's life expectancy. So if your beneficiary is significantly younger than you, they have a longer life expectancy, we're going to expect to pay them more, so we're going to pay you less. And that less starts at the time of retirement. It's all calculated at the time of retirement. And if your beneficiary dies before you do, we don't increase your retirement allowance. And you can also name a new beneficiary, but only for lump sum payments. One thing to note here is that if your beneficiary is more than 10 years younger than you, there's going to be a significant reduction of what your retirement allowance is. One other thing to note that is not a bullet point on here, if your beneficiary is somebody other than, and this is something that we all just learned recently, if your beneficiary is somebody other than a spouse or state registered domestic partner, and they are more than 10 years younger than you, then this might not actually pay 100%. There's an IRS chart that we're going to be publishing on our website pretty soon that shows like it's less in increments of how much younger than you they are. So that's just something to consider. Okay, option number 3. Option number 3 is the exact same as option 2. The only difference is that rather than paying 100% continuance to your beneficiary, it pays 50% of whatever you were making as a retiree, whatever your retirement allowance was. So whatever your retirement allowance was, they'll get half for the rest of their life. Again, you can name anyone. And again, the reduction, this is going to pay less than an unmodified option, and the reduction is going to be based on your beneficiary's life expectancy. But because we're going to pay the beneficiary less in this scenario, we're going to pay you more as a retiree. So this option 3 pays you more, and you have a higher retirement allowance in this one than you would in option 2. But all the same rules apply. But that thing that I just told you about the chart where it pays less than 100% if it's a non-spouse or domestic partner and they're more than 10 years younger than you, that doesn't apply. Okay, option number 4 is the exact same as options 2 and 3 in that you can specify anyone as a beneficiary for a continuance, but this is the option that lets you specify more than one person for a lifetime continuance. So you could specify 2 people or 3 people, like you could specify 2 adult children for a lifetime continuance after you die. And you couldn't do that under the unmodified option because it's only minor children that you can name for a continuance. So this gives you that option. And otherwise, it's the exact same as options 2 and 3. And you can specify a dollar amount or a percentage that will be split to each one of the continuance beneficiaries. The amount less than the unmodified option that this pays is going to be based on the youngest beneficiary's life expectancy. So the question is, if the spouse is more than 10 years younger than you, does that affect the unmodified option? No, it doesn't. We don't care about the spouse's age in the unmodified option. The only thing we care about in the unmodified option regarding the spouse is the fact that you married them at least 1 year before your retirement. Okay, so those are the 5 options, the unmodified option and options 1 through 4. Now, those are kind of abstract concepts. If you want to get into some concrete numbers, the best way to do it is go to our precision benefit estimator on our website. So here's that screenshot again. So you do your retirement scenario. What you want to do to make sure that the estimate is accurate is make sure that you put in accurate information here. Okay, so if you have designated a beneficiary already with ACERA for active death benefits, which is a really good idea to do because you may pass away before you retire, and then we need to know who to pay the death benefits to. There are active death benefits. If you have designated a beneficiary, you will see them in the drop down here, or you may see them, and you can go ahead and select them. If you do select them, make sure the date of birth is correct, because some of them are not correct, and that will throw off the numbers. Otherwise, you can just type in the information into these fields, and you hit Get Estimate. You end up with your Precision Retirement Benefit Estimate PDF. And to zoom in here again, now that I've shown you the options, you can kind of understand what the different estimates are here for each one of the options. So it gives you an estimate for the unmodified option, option 1, option 2, option 3. Option 4, it doesn't give an estimate because the math is complicated. So if you want an estimate for that, you need to submit a retirement estimate request form to us. But you'll see that when you look at this, you'll see that this will give you an idea of like what the reduction is from options 1, 2, and 3 from the unmodified option, because you'll notice the unmodified option pays the most, the highest number. You'll see that the beneficiary's allowance is 60% for the unmodified option. You'll see that option number 1, the beneficiary is grayed out because it doesn't pay a continuance to anyone. You'll see that for option 2, these two numbers are the same because it pays 100%. For option 3, you'll see that this number is 50% of this because it pays 50%. You'll see that option 3 is more than option 2. So it kind of gives you the concrete numbers for those ideas that I was just showing you. It also gives you another couple of numbers for option number 1. This is the total balance of the contribution and interest account. Based on option 1, there's some kind of different accounting here, but you can just go by these numbers. What it's telling you is how much money, what the total balance is, and how much is going to come out of that total amount each month that you receive a retirement allowance. So this would be your retirement allowance, and every month this total is whittled down by this much. So if you want to see how long this money there will be a balance in here, all you do is you take the big number and you divide it by the little number, and that tells you how many months that will last. And if you take that number and divide it again by 12, it will tell you how many years it will last. And like I said, that money should last about 10 to 12 years. There would be a balance in there for a lump sum beneficiary. Okay, those are the 5 retirement options. So moving on to the next item in the checklist, understanding other benefits. So we're going to talk about medical, dental, and vision benefits in this section of the presentation. So the medical, dental, and vision benefits are a little bit different than the other benefits we've been talking about. We've been talking a lot about vested benefits, which are guaranteed. These benefits, medical, dental, vision, are not guaranteed. These are extra benefits that at some point in the past, the county decided that the retirees would need to have some extra benefits to be able to pay for their lives in retirement. And so they started a reserve fund that pays subsidies to help retirees in these categories of medical, dental, vision, and some other stuff. So the Board of Retirement, what they do, what their job is to administer this reserve fund. So they determine what the benefits are, they keep track of this fund, and their goal is to ensure the sustainability of the fund. Currently, there's over $900 million in this fund, so there's a lot of money in there to pay for these benefits. But the Board of Retirement, what they do is they may adjust the rules or what the benefits are periodically, or the levels of benefits, in order to keep the fund sustainable. So that's just a caveat that'll tell you that the rules may change periodically, or the benefit levels may change, or often what they do is they won't increase the benefits from year to year in order to ensure that fund sustainability. So they'll just hold them at the same level for another year. So here are the benefits, the non-guaranteed benefits as they currently are. There's a medical subsidy known as the monthly medical allowance. That doesn't stand for mixed martial arts. It's monthly medical allowance in the context of a SARA. And there's 3 levels of that you could be eligible for. And that helps you pay for the cost of being enrolled in our medical plans. There's also a dental subsidy, vision subsidy, Medicare subsidy to help you pay for the cost of being enrolled in Medicare, and a supplemental cost of living adjustment, which is on top of the vested cost of living adjustment. And this chart is illustrating how many years of a SARA service credit you need to qualify to be eligible for these extra benefits. And the supplemental cost of living adjustment, everyone's eligible to get, and then all the other ones start at 10 years. And the lowest level of the monthly medical allowance starts at 10 years, and then there's a couple more levels at 15 and 20 years of a SARA service credit. So let me talk about each one of these a little bit more and show you what the different healthcare plans are and how much of the healthcare plans subsidies pay for, to give you an idea of that. So we'll talk about the monthly medical allowance first. This, again, is a non-guaranteed benefit. What this does is it offsets the cost of your enrollment in one of our SARA-sponsored retiree medical plans. So when you go to retire, you have the option of choosing one of our plans because you're going to need to get off your employer's plan eventually, if not at the time of retirement. And we have group plans and individual plans. And for group plans, it offsets the cost of premiums, which is the monthly cost of you being enrolled in the medical plan. For the individual plans, it offsets not only premiums, but also copays and deductibles. The amount is set annually by the Board of Retirement in order to, manage the sustainability of the reserve fund. Any one of these costs that exceeds what the subsidy pays, you're responsible for paying. And it's only for you, the retiree. It doesn't pay for the costs of covering your beneficiaries, survivors, spouses, any of that. You can enroll them, but they don't get a subsidy. Okay, here are the 2020 monthly medical allowance amounts. And in fact, I need to change the slide to 2021, and these amounts are the same for 2021. So that's just an illustration of the fact that the board decided this year to hold the amounts the same for 2021 in order to maintain the sustainability of that reserve fund. So if you have 20 or more years of ACERA service credit, you would be eligible for the full monthly medical allowance amount of $578.65. If you have at least 15 years, it would be the three-quarter amount, $433.99. And if you have at least 10 years of ACERA service credit, you would be eligible for the one half of the monthly medical allowance, which is $289.33. Okay, now remember those numbers, what your situation might be, because now I'm going to show you what the costs of the medical plans are. We have our open enrollment for our medical plans is every November. We have two categories of plans that I'll show you based on whether you're eligible for Medicare or not. Medicare is the federal government's healthcare system, and you generally become eligible at age 65, and then over age 65 you're eligible. If you're under age 65, then you would not be eligible for Medicare, and you would pick one of these plans. And you can see that there's three companies: Kaiser Permanente, United Healthcare, and Via Benefits. So I'm going to show you each one of the plans, and I'm going to do the group plans first. So Kaiser Permanente and United Healthcare. I'll show you the non-Medicare plans first, and then I'll show you the group Medicare plan. And the reason I'm going to do that is I'll show you the individual plans through Via Benefits both at the same time, non-Medicare and Medicare, because it's easier to explain that way. So I'll show you the non-Medicare eligible group plans first. And these are just a few of the details of the plans. The full plan details are in our annual enrollment guide, and I need to change this graphic. Sorry, I keep saying that there's like 3 or 4 things in here that I need to update for 2021. We do have a new enrollment guide, and you can find that on our website. If you go to acera.org/guide, it'll pop right up. These are the non-Medicare group plans, and these are their costs for 2021. So we have the Kaiser Permanente HMO, United Healthcare Signature Value HMO, and United Healthcare Signature Value Advantage HMO. Previous to this year, previous to 2021, the Kaiser Permanente HMO was always the cheapest, but new for this year, United Healthcare Signature Value Advantage HMO is actually the cheapest one of these plans at $759.16. And so you can see that here's the self premium for each one of the plans, and then if you want to enroll self plus one, here's the premiums, and family, here's the premiums. The copays for all the plans are $15. Regarding the Signature Value Advantage plan, the difference between the Signature Value plan and the Signature Value Advantage plan is that you have to stick to what they call this narrow, high-performing network of providers, of like doctors and facilities. And what they found when the county studied this, because they negotiate these plans, is that almost everyone who was already enrolled in Signature Value was already sticking to that network anyway. And so by switching to the Signature Value Advantage network, you save 34%. It's way cheaper than the Signature Value plan. And for this year, the Signature Value Advantage plan for United Healthcare is even 6% cheaper than Kaiser Permanente. You can see it's about $50 cheaper per month. So those are the non-Medicare group plans. The way the monthly medical allowance works with these plans, with the group plans, is it comes in and out of your ACERA check. This is an incredibly crude version of your ACERA pay stub, just simplified for this presentation. So on your ACERA retirement allowance pay stub, you would see your gross pay. And in this example, here it is, $4,000. If you enroll in one of our medical plans, or one of our group medical plans, this is the group plans only, not the individual plans, what we're going to do is deduct the premium for that plan from your retirement check and send it over to the group plan provider as a convenience to you. So in this case, it's Kaiser Permanente, and we are subtracting the Kaiser Permanente HMO amount. And then in the additions column, you will see the monthly medical allowance that you're eligible for go back into your check. So you'll see the premium come out of your check and the deductions, the monthly medical allowance, if you're eligible for it, go back into your check in the additions column, and you end up paying the difference. You can see that the monthly medical allowance, even at the 20-year level, does not pay anywhere close to 100% of any of the self-premiums for the non-Medicare plans. $578. So even at the Signature Value Advantage plan, you end up paying like maybe like $180 out of your check. Okay, now I'll show you the Medicare group plan option. There's only one option for group plans. If you're Medicare eligible, what you do is you go ahead and enroll in Medicare through the federal government, Medicare Parts A and B. And the federal government, when you do that, is going to provide a certain level of care. Now, if you want to, you can enroll in one of our Medicare plans that provides an even higher level of care than Medicare alone provides. So that's what these Medicare plans are, like this Kaiser Permanente Senior Advantage plan. So here are the premiums for the Kaiser Permanente Senior Advantage plan for 2021. The self-premium is $382.21. For this slide, I've given you some additional numbers here. Not only have I given you the +1 and the family numbers, but there's different combinations of if you're adding people to your plan, if you're like adding a spouse, if you're both Medicare eligible, or if only one of you is Medicare eligible. And then plus, I put in the 20-year monthly medical allowance numbers to illustrate what the out-of-pocket cost would be for you. And so you'll notice that the 20-year monthly medical allowance number here on this slide is $382.21. Now that wasn't one of the monthly medical allowance numbers that I showed you on the first slide. The reason for that is because the monthly medical allowance, the rules are that it only pays up to the amount of the self-premium for the group plans. So because the 20-year monthly medical allowance at $578 is more than $382.21, it only pays up to the $382.21. So it makes your out-of-pocket cost zero for yourself. But what it does is if you're enrolling your spouse and you're Medicare eligible, it makes it so your monthly medical allowance is lower at $382.21. If your spouse is the one that's Medicare eligible and you are not, this would still be your $1,192.93 would still be your premium amount, but your monthly medical allowance would actually be higher in this 20-year monthly medical allowance scenario because it's not limited to this self-premium, it's limited to the other self-premium for the non-Medicare plan. And so this is the bottom line. This is your out-of-pocket cost in these different scenarios. Okay, so I showed you the group plans and what the premiums are for the group plans. Now let's talk about the individual plan options. Who can enroll in an individual plan through this company via benefits that we contract with and a SARA-sponsored individual plan? If you're not yet Medicare eligible, you can enroll in a plan if you live inside the US, but outside of the ACERA group plan service areas. And the service areas for those group plans, the Kaiser plans and the United Healthcare plans, are the San Francisco Bay Area, Sacramento area, Fresno area, Southern California, like a big swath of Southern California, and for the Kaiser plans, also Santa Cruz. And that's kind of a general idea of where the service areas are, but it gets down to like zip code and address. And in order to determine whether you're in or out of the service area, you can contact the healthcare provider and they'll tell you. If you're in the group plan service area and you're not yet Medicare eligible, you have to choose one of the group plans. You can't pick an individual plan. But if you're out of the service area, like let's say you move to another state out of California, or you move to a part in California that's not in the service area, like Redding. Move up to Redding, that's not in the service area, and you can choose an individual plan. Now, if you're Medicare eligible, you don't have to think about that. You just need to live anywhere in the US and just enroll in Medicare Parts A and B. and then you can enroll in an individual Medicare plan through VIA benefits. Now, what is VIA benefits? It is a private health insurance exchange that we contract with. And they contract with a bunch of different insurance carriers, like over 80 different insurance carriers across the nation. There's like 1,000 different plans that they offer. And what they do when you contact them to inquire about a plan is you, especially if you can do it on telephone or via telephone or on the website, but if you do it on telephone, you'll talk to a non-biased benefit advisor. They don't get a commission based on which plan they put you in. They're just salaried. So they're going to narrow down the plans to what's right for you. So you tell them, you call them up and you tell them where you live or where you're going to live if you're going to move, how much you want to spend on healthcare, what kind of level of coverage you're looking for. You can even get as granular as what medications you are going to need, and they'll put that in their database and figure out what, if you're on a Medicare plan, what prescription drug plan you need, you can tell them what providers you want to see. So they will help you narrow down all the plans to a few, and then you can choose among those few that they narrow it down to. The monthly premiums for those plans are going to all depend on which plan you choose. They're all different. The benefits are all going to depend on the plan you choose. Now, the monthly medical allowance for these individual plans not only pays for premiums, but also deductibles and copays, unlike the group plans. Okay, let me take that question in just a minute. So, VIA benefits, sticking with VIA benefits. The monthly medical allowance is distributed differently if you enroll in one of these individual VIA benefits plans. So it doesn't come in and out of your Acera check. You have to pay your premium directly to the insurance company, and then you're going to get reimbursed in a different way than in your retirement check. So here's how this works. Here's another crude illustration of a concept at Acera. This is Acera. And if you're eligible for the monthly medical allowance, here is us with your monthly medical allowance money. So what we're going to do is if you enroll in an individual plan through VIA Benefits is going to open up a health reimbursement account for you, an HRA. And Acera is going to send your monthly medical allowance over to VIA Benefits to your health reimbursement account, where it will sit. Okay, here's your bank account. Now, you're going to enroll in an individual plan. You're going to have to pay an insurance company that monthly premium to be enrolled in that plan. Then you're going to go to the doctor. You're going to pay a doctor for a copay to visit that doctor. Now, your bank account is out some money here. So what you do is you submit reimbursement claims back to VIA Benefits, and they will pay you your monthly medical allowance out of your health reimbursement account back to your bank account. You can set up a lot of this stuff to happen automatically. So you can make recurring automatic payments to your insurance company. I highly recommend it. It makes it very easy. You can set up auto reimbursements for that to your bank account. That makes it very easy. VIA Benefits will help you set up all of that stuff with direct deposit. And then all you would need to do is whenever you visit the doctor, you submit reimbursement claims for that. And you can do that on their website. And also I think they have an app that will help you submit those reimbursement claims as well, to just make it very easy for you. One more thing about VIA Benefits is if you're Medicare eligible and you're going to get a VIA Benefits Medicare plan, the monthly medical allowance amounts are a little bit less because these plans are so cheap. The board decided, because the plans are so cheap, that the monthly medical allowance should be a little bit lower for these Medicare VIA Benefits plans. For the non-Medicare VIA Benefits plans, the monthly medical amounts are the other ones that I showed you before. So you can see that it's a little bit less, but we do keep track of how many people, what amount of people run out of the money, and we find that over 90% of the people who enroll in these plans, um, who have at least 20 years of the 20-year monthly medical allowance, uh, over 90% of the people, this amount is totally adequate to pay all of their medical plan costs for the year. Okay, so before I move on to dental plans, let me address this question here. Does the monthly medical allowance supplement apply to self and spouse if applying for the self plus one medical plan? It does not, because what I said earlier, like I said earlier, the monthly medical allowance only goes to cover your medical expenses, not your spouse's. It's a benefit that your employer has set aside for you, the employee. And so if you're looking at the Kaiser Permanente Senior Advantage chart, you'll see that the only amount here is your monthly medical allowance that is going to offset the cost of being enrolled in these plans, even if you're enrolling self plus one in all of these scenarios. So I hope that answers your question. So let's talk about dental plans and the dental subsidy. You also have the ability to enroll in dental coverage through ACERA. If you have at least 10 years of ACERA service credit at the time you retire, it won't cost you anything. And in fact, the enrollment is mandatory, but it doesn't cost you anything. So the self premium for, there's two plan options, Delta Dental PPO and Delta Care USA. And the self premium is the same amount as the subsidy. So for example, if you had at least 10 years of ACERA service credit and you enrolled in the Delta Dental PPO, your self premium would be $44.15, and that would come out of your check in the deductions column. And then in the additions column, you would see $44.15 go back in as a subsidy. And so it ends up costing you zero. And I'll take this moment to say that none of these subsidies are taxable. This is not taxable income. We have it worked out with the IRS. So this does not increase your tax liability to get any of these subsidies. So then you can enroll self plus one and family. So for example, if you were enrolled self plus one, you would see $85.96 come out of your check, and then your subsidy amount is going to be $44.15. So you would see that go back into your check, and you would pay the difference. Now, if you have less than 10 years of ACERA service credit, there is voluntary enrollment. You don't have to enroll. You can voluntarily, and there's a different set of premiums that you would be looking at, and then there's no subsidy. Delta Care USA is a California-only plan, and Delta Dental PPO is nationwide. So for the vision plans, it's very similar to the dental plans. If you have at least 10 years of ACERA service credit, you must enroll in at least the VSP standard plan, but it costs you zero. The self-premium and the subsidy are the same amount. Now you have the option for the vision plans of buying up into a premium plan, VSP premium. And then what you pay, the subsidy doesn't go up, but you pay a higher premium, so you would end up paying the difference between $14.26 and $3.97, which is the subsidy. One thing I know off the top of my head that the difference between these two is with the premium plan, you get frames every year rather than every 2 years with the standard plan. And again, if you have less than 10 years of ACERA service credit, you can voluntarily enroll if you like, and there's a different set of premiums. Okay, the next benefit we'll talk about is the Medicare Part B reimbursement plan. What the Medicare Part B reimbursement plan, and I'm not sure that we have the amount for 2021 yet. I think that's coming this month, and we'll post it out on our website when we know what it is. But what it does is when you are Medicare eligible, you're going to enroll through the federal government in Medicare Parts A and B. If you have at least 10, I think it's 10 years of employment that you've paid into the Medicare system, Medicare Part A, which is hospitalization, will be free for you. Medicare Part B, however, which is doctor's visits, will come with a cost. And Medicare will start charging you. For 2020, it was $144.60 per month at the lowest income level. And they will charge you that amount to be enrolled in Medicare Part B. Now, what the Medicare Part B reimbursement plan does is it reimburses everyone who has at least 10 years of a service credit. It just reimburses them for the cost of being enrolled in Medicare Part B at the lowest level. So Medicare charges you $144.60, and then you'll see $144.60 show up in your SARA check if you enroll in the Medicare Part B reimbursement plan. If you have at least 10 years of a SARA service credit or a service-connected disability retirement, and you're enrolled in Medicare Part B, there's no reason not to enroll in this. If you don't enroll in this, you're missing out on money every month in your SARA check. And we don't pay it retroactively, so you just, as soon as you're eligible for Medicare, you just go ahead and enroll in this. And you just must maintain enrollment in Medicare Part B. Now, this is not something that you necessarily have to remember to do. We will, when you turn 65 in retirement, we're going to send you an invitation to attend one of our Medicare transition seminars, and we'll help you get enrolled in this at that time. If you're already 65 and you're still working, we're not going to send you an invitation approaching your 65th birthday, but you can just go ahead and enroll in one of our Medicare transition seminars in our events menu on our website. Okay, the last non-guaranteed benefit I'll talk about is the supplemental cost of living adjustment. You already are going to get the vested cost of living adjustment, so that's guaranteed. Now, the supplemental cost of living adjustment is paid on top of the vested cost of living adjustment, and what this does is it maintains your buying power in retirement. So if at any point in retirement you lose so much buying power, enough buying power compared to what you had at the time of retirement, you lose more than 15% of your buying power to inflation, the supplemental cost of living adjustment kicks in and keeps you at 85% of your original buying power in retirement. So you cannot lose more than 15% of your buying power to inflation in retirement. So this is a really important benefit. Okay. So those are the non-guaranteed benefits. Let's talk really quickly about some different life events. So I only have one slide on this, and the reason is that not all of these life events are going to apply to everyone. So I just want to inform you that these different concepts exist, and if you want to seek more information on these, you can go to these links on our website. If you are, the first one is deferring retirement. So if you're going to quit before retirement, so you're not going to go straight from active work into retirement, there's going to be a gap between when you stop working and your retirement. You will become what's known as a deferred member. And there are some special things that you should know about being a deferred member, and so you can go ahead and explore that information on our website. A good thing to know about your ACERA benefits is what should happen should you die before retirement, because we went into a lot of detail about the death benefits when you die as a retiree. But should you die before retirement, hopefully that doesn't happen, but there are death benefits available should you die prior to retirement. And so that is a good topic to explore on our website. Regarding the next one is divorce or domestic partnership dissolution. California is a community property state, which means that if you were married or you were in a state registered domestic partnership during your ACERA membership where you were earning benefits, a portion of those benefits are going to be some or all of those benefits are going to be on the table as community property for division should you get divorced or dissolve your domestic partnership. So it's a good idea to go ahead and read through a divorce page um, and understand how divorce or domestic partnership dissolution would affect your SARA benefits or could affect your SARA benefits. There's, if you negotiate it right, you could maybe have no effect if you give away, something else. But yeah, you can check out that page on our website. Now, disability retirement, what we've been talking about throughout the presentation is just the regular retirement, what we call service retirement. If you ever become permanently disabled and you cannot perform your job duties anymore and you can't go ahead with your plan to do the regular retirement, you could retire early through a disability retirement. And so we have a lot of information. We have a whole section of our website on disability retirement. And in fact, we have a disability unit at Acera that will guide you through that entire process. And so there's contact information on our disability retirement page, and they would like the disability unit would like you to contact them early in that process when you're making inquiries about disability retirement. If you're going to work after retirement and you're going to go to work for any employer except for our 6 participating employers, we don't care. You go to work for whoever you want to work for, and we're going to still consider you retired. You're going to get that lifetime monthly retirement allowance, and it's going to be great. If you go back to work for your employer or one of the other 5 participating employers at Acera, there are duration limits and restrictions around that. And so you're going to want to familiarize yourself with that, with those before you make that plan to work for one of those employers after retirement. And then finally, if you're going to relocate after retirement, lots of people do. We have Acera retirees living all over the country and all over the world. That's beautiful. Like, go live where you like. You're still gonna get your retirement direct deposit. Now, if you do relocate, the one thing that we ask is that you just tell us where you move to, and you do that by filling out our address change request form, and you can find that at this website, and that helps us continue to send you official communications. If we need to send you any letters, we're going to continue to send you our annual report, and very importantly, that is the address we're going to send you our open enrollment packet that you're going to get each October. And so we're going to want to make sure that we have the correct address for you to receive that. And finally, the last item on the checklist, we recommend that you go ahead and sign up for Acera News. You do that at acera.org/subscribe. And I say we only send important news to say that if you sign up for our email subscription service, you're not going to get inundated with a bunch of crap, okay? You're not going to see your inbox pile up with stuff. We only send important news if something changes with Acera, or if it's something that our members need to know. Like, once in a blue moon, we send out a mass email to our subscribers. So if you don't want to check our news page all the time to see what's going on with Acera, go ahead and do acera.org/subscribe. And every time we post something to our news page, we also send it out to our email news subscribers. The one option in there where you might receive a little bit more email is if you sign up for our wellness emails. Then we tend to send those out a little bit more regularly. If you have any questions at any time after you watch this presentation, go ahead and call us, 510-628-3000. I think we're answering phones 9 a.m. to 3 p.m. Pacific Standard Time on business days currently. But you're going to want to go ahead and check our contact page on our website to make sure that that's still accurate whenever you're trying to call in. But we have people who their entire job is to answer your questions, and they're experts on a lot of different topics. So feel free to call us with any of your questions at any time. So with that brings us to the conclusion of our pre-retirement seminar. I want to really thank you for spending this time with me. I know it's a lot of stuff, but we really just want to make sure that you have all of the information you need to be able to cruise easily into retirement and have a beautiful retirement after that. So on behalf of Sarah's Board of Retirement and Sarah, we wish you a beautiful retirement. And so I wish you a beautiful day for the rest of your day and a beautiful life. Thank you.